some of the very successful entrepreneurs have come in pairs, like in Google and Hewlett Packard, whatever. What do you see the merits of a single entrepreneur versus two? Because as an engineer like yourself, I find it very hard to get interested in customers and all this stuff. So that often two people working together that complement each other can be more successful, I suspect.
I think that we probably run into that pretty frequently, and we find that those two individuals probably still have some holes in their resume, so they need the kinds of experience that an experienced board of directors might bring to them. But I also have some caution for entrepreneurs who are thinking about bringing a partner along as they start their company. Commitment is a really, really serious issue. If you're starting a company and you give away half of it, 50% of it to a partner at the very, very beginning, and you later learn, oh, they were just kidding, or, oh, you mean I actually have to give up my day job, or you mean I can't earn $120,000 next year like I earned last year because the business can't afford it, or you mean I really have to work 80 hours a week? When you find, you often find with partner entrepreneurs that there's a lack of commitment in one person and the other. Now, there are lots of great examples of teams. Hewlett Packard is a very, very famous one. You gave the example of Google as another one. What I like the best about Hewlett Packard, they put the team together first and then they say, what could we make? Let's see. Maybe we can make a product and sell it to somebody. What a concept. I mean, that is a wonderful success story. I love that story.
Bill, what's the question?
Okay. Yes, sir.
Can you talk a little bit about how you structure the deal?
So the question is, how do we as angel investors structure the deal? Typically, we angels invest at the startup pre-revenue stage. The company's identified some customers but hasn't actually sold anything or sold very little. So let's say less than a couple $100,000 a year in annualized revenues when we invest. We might be buying 20 to 40% of the company in an equity deal for an investment of somewhere between $250,000 and $1 million. So if the company's a little bit further along, they've got a little higher valuation, we get a little bit less stock. If the company needs a lot more money to get started and they haven't got anything accomplished yet, we're probably going to own a little bit more of the company. I would prefer investing in preferred shares rather than ordinary shares. Not all angel investors are of that ilk, but that happens to be my particular preference. And the term sheet would also describe other terms, but especially we would be defining the board makeup, who will be representing the investors or the entrepreneur, what's the size of the board, what's its makeup, et cetera, et cetera. And we will also have a serious discussion during the due diligence period with the entrepreneur as to at what point in this venture might it be appropriate for the entrepreneur and the investors to actually go out and hire a professional CEO. Because it's very often the case that the business opportunity can grow faster than the skills and experiences of the entrepreneur. Not always. There are many, many examples of wonderful entrepreneurs who've taken it all the way. But I think it's a topic that needs to be addressed at a very early stage in discussions between investors and entrepreneurs. So the question is, angel investing a science or art, and how does it change over time? And clearly, if your batting average is 1 out of 10, it ain't no science. So, and are we getting better? The problem is that our really, really wonderful exits take 8 years or 10 years to mature and get us to a point where we can do a trade sale or maybe an IPO. So it takes a long time to measure change in this environment. But I will tell you that we've got documented evidence that due diligence matters. That means how much do we as investors study the deal and the market and the team and the channels, etc., before we invest. We've got really good data that says that matters. And I will tell you, Andy, we're doing a lot better due diligence today than we were 10 years ago. So I expect our returns to improve gradually over time. I cannot report from my portfolio that that's yet true. Yes. Yes, sir.
What sort of success you have recently seen of Kiwi companies in U.S.? Have you seen any Kiwi companies raising money in U.S. or?
I'm sorry, what kind of companies?
Kiwi, New Zealand companies.
Kiwi companies raising money in the U.S. It's inappropriate for Kiwi companies to run off to the U.S. to try to raise money. I think the appropriate answer is go create some traction there first, and then you can make a great case for raising money there. So if venture capitalists in particular see a thriving Kiwi company that has great revenues in the U.S. and is getting great traction there, it's very likely they might want to structure a deal with you there. But just, buying a plane ticket and going to Silicon Valley and planning on knocking on some doors and raising some capital simply is not going to work. So I think it's more appropriate to think about markets first and financing later than the reverse. So the question is, what are my observations related to social entrepreneurs? I think social entrepreneurs do good things, but they're not my bag. I'm an angel investor and I invest in for-profit ventures. I think there are people, and perhaps Peter Thiel's a good example, of individuals who will fund social ventures. And I'm not speaking ill of social ventures. I think that they have done very, very good things, and I encourage more social ventures. It's just not my area of expertise. I just operate in a different environment. So up here?
With regard to the angel investors, in an earlier presentation I heard from you, you mentioned you tend to stay within an hour or two of your own physical location at home. Within the Kiwi angel investors, do they tend to stay the same, or do they cover the whole country?
So the question is, do Kiwi angel investors tend to invest over a broader geographic area than do we in the U.S.? Because she heard me say earlier that we tend to invest within an hour or two of home. What's happened in the capital food chain is that there's a real gap in funding at above $750,000 or $1 million. It's really hard to find $1.5 million or $2 million. So what angels throughout the world are doing is we're syndicating deals. So a local group will study the deal. If they really like it and they agree to write checks, they will then show the deal to other angel groups who will then, if they're interested, fund the deal. That's what's happening in New Zealand. That's what happens in the U.S. So an Auckland entrepreneur may well get funding from a Wellington angel, but it'll probably come because the Ice Angels in the Ice House or some other local angel group studied the deal, is leading the investment, and is then showing it to other angel groups in the country. So we these days tend to have a little broader set of investments, but we're passive on those that are out of town. We're active on the ones that are in town, and we're syndicating deals because it's really hard to raise, $1.5 million or $2 million these days. Thank you very much, ladies and gentlemen. I truly enjoyed the evening. Thank you, Greg.
There's a few things we need to do.
Okay.
Bill,